Welcome to the latest episode of our podcast series for financial advisors. Today's episode is a special rapid reaction industry update. Vanguard acquires Altruist, what it means for advisors and the industry. I'm Louis Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
Funny how the biggest news in the business almost never comes from the firms everyone is watching. On Wednesday, August 26, 2026, Vanguard announced it's acquiring Altruist. If you asked me a year ago to name the company most likely to buy an RIA custodian, Vanguard would not have been near the top of my list. Vanguard was in the RIA custody business once. They left in 2003 and handed roughly $120 billion of advisor assets to TD Ameritrade on the way out. 23 years later, they're buying their way back in, reported $4 billion or more. So let's talk about what happened, why it matters, and where I think it goes from here. What happened? On August 26th, 2026, a definitive agreement was announced out of Valley Forge, Pennsylvania. A deal is closing later this year where Vanguard is acquiring Altruist, the relative upstart RIA custodian. The price, an undisclosed number, but a reported $4 billion, some outlets reporting $4.6 billion or more. Either way, more than double their last private market valuation at the end of April 2025. Another element is Altruist is staying as a standalone. They'll keep their brand, CEO, management team, and operate the same model, just as a wholly owned subsidiary of Vanguard. Altruist, in one breath, for those unaware, was a custodian and fintech company founded in 2018 by Jason Wenk. They became a self-clearing custodian, third largest as far as number of advisors served, north of 6,000 advisors, and had a reputation for serving smaller or upstart advisors, but recently started getting into more of the larger market breakaway space. One estimate I've seen pegs Altruist's market share of RIA custody at around 6%, but you compare that to about 3/4 of the market for Schwab and Fidelity combined. So a relatively small player, but a rapidly emerging player and threat in US RIA custody. This is not the first time Vanguard has been involved with Altruist. They reportedly were an early investor in Altruist back in 2000, and former Vanguard CEO Bill McNabb has been on the board of Altruist. So a lot of history between the firms. Let's get into now why I think this is interesting for the industry as a whole. In my view, custody has never really been all that competitive, especially since TD Ameritrade sold to Schwab. You really had an oligopoly between Schwab and Fidelity. Sure, there's a number of compelling, say, more boutique custodians, whether Pershing Advisor Solutions, Goldman Sachs, which was another newer entrant to custody, LPL, Raymond James, First Clearing, and a number of others are also in the space. But it is a market that is dramatically dominated by the 2 largest players. So I think this matters because you add an amazing, venerable brand and reputation of Vanguard with this scrappy upstart custodian. And all of a sudden, you can see a world where custody is one of the more competitive spaces in the industry. Altruist, in my view, too, was one of the first credible challengers to the incumbent custodians in 20-ish years. Goldman has since picked up some decent market share, and certainly they're attractive for a segment of advisors. But Altruist, with their tech-forward approach, low fees, and even just the way they went to market as an antagonist to Schwab and Fidelity, they're a big deal. And I think this just magnifies what they're able to do. The gap, though, for Altruist was brand and reputation. Sure, they had amazing tech. No one ever has doubted that. Hazel AI, which they recently launched, has been very well received. Advisors I've worked with who have demoed the platform are incredibly impressed. The big Achilles heel, though, for Altruist has been, my clients don't know who Altruist is. Why would my clients put their millions of dollars of wealth with a self-clearing custodian that doesn't have the same scale or reputation as the incumbent custodians? Well, that really goes away here. And at the end of the day, custody is really a trust business, but you'd have to think that a client would trust their assets held with Vanguard or with Altruist through Vanguard in a very similar way that they would trust assets held by Bank of New York Mellon or Charles Schwab or Fidelity Investments or Goldman Sachs. So to me, Vanguard acquiring Altruist solves that problem in one sentence. Very simple. Why I think this makes sense for Vanguard. Salim Ramji, the CEO of Vanguard, has been saying since he arrived from BlackRock 2 years ago that only 1 in 5 Americans work with a fee-based financial advisor, and that quality advice shouldn't be a luxury good. And this shortage is only going to get worse as advisors retire. This is really him putting his money where his mouth is and really trying to make financial advice, human-directed financial advice, more accessible to everyday Americans and the upper echelons of wealth in this country. Vanguard as a company has over 50 million reported investors and over 12 trillion in assets. A lot of these people want Vanguard advice, but Vanguard hasn't had the manpower or the capacity to deliver it itself. Buying Altruist over time can certainly solve that capacity gap and make it so that a human-based financial advisor or any of Vanguard's internal platforms now have a greater ability to provide advice to Americans looking for financial advisors in the United States. I think this also means more distribution capability for Vanguard funds. Not that Vanguard has ever had a problem with distribution. They have a relatively small wholesaling force compared to other firms, but given their cost and reputation and performance, they're really on pretty much every platform. Most advisors have some clients that are invested into Vanguard mutual funds or ETFs. But this, I think, just gives them a greater ability to distribute Vanguard products, probably in a similar way to Goldman's approach. When Goldman entered US RIA custody, in large part, they were doing it for distribution of different things. For Goldman, it was private markets and lending and other types of products. Vanguard is more ETFs and mutual funds, but Vanguard has also been pushing more into the private market space. So I can definitely see a world in which they can ratchet up the distribution of their products in a fairly cost-efficient way. I think to me, the most interesting thing about this marriage is the mission overlap is quite real. When Vanguard started, and to this day, their goal was to provide quality investment products at a fraction of the cost of the incumbents so that investing can be accessible to everyday Americans. That's exactly the verbiage that Jason Wenk and Altruist has used from the beginning, where they want to become a all-in-one hub or tech-enabled custodian so that an advisor, regardless of their size, and a client, regardless of their AUM, have the ability to get quality advice. I recently listened to a podcast called Acquired. We'll link it in the show notes, but it's a 3-hour in-depth look into the building of Vanguard. And if you combine that with the podcast episode that I recorded with Jason Wenk, the CEO of Altruist, if you play them side by side, the parallels are eerily similar. So we'll link both into the show notes, but I really think both of these firms were cut from the same cloth. And really from the beginning, both have gone against the grain and tried to rattle incumbent players in the industry. So at least on paper, seems like a very good match. Why does this deal make sense for Altruist? For one, if for Jason Wenk and his leadership team, this has to be the outcome you drew up, maybe even better. Founding a new custodian in 2018, selling it in 2026, 8 years later, for over $4 billion. That's a pretty incredible return on time for this team. They deserve it all and built something special and really entered into a space where no one wanted to venture, just given the market share of the major incumbents. But good for them, and it has to feel good to pull off this type of sale. I think the big thing too is the buyer is the story. Vanguard as a company is investor owned. They're not private equity owned. They're not VC backed like Altruist was. So Altruist can get off of the fundraising treadmill. They don't have to worry about fund life or a 5-year hold period or an eventual sale to a strategic. Now they can really just focus on the business at hand, having one of the most well-capitalized companies in the world as their capital backer and owner. And every advisor on a PE-backed platform knows the question hanging over every relationship: who owns us next? That's a question they won't have to answer anymore at all. And they can really just focus now going forward. I think this also gives Altruist a fortress balance sheet and a ton of capital to keep pushing and developing their Hazel AI platform, which was launched in September 2025. Hazel's an AI tax planning tool, kind of AI superpower that really has taken the industry by storm. And it started to be sold as a standalone product to RIAs. And from what I've seen, they've sold it to over 1,600 new RIAs just in the first month alone for $60 a seat per month. And that's available to folks if they custody Altruist or not. So this, I think, just gives them an ability to distribute their fintech solutions and certainly develop their custody platform in a way that maybe was challenging or not as possible before. They can also take a longer term view. Instead of having to worry about they raised a Series F, whatever comes after F and an eventual sale, investors wanting to get a return on capital, they can now focus on building over the long term, which has been Vanguard's strategy all along. I think too, this will give Altruist the ability to invest in new capabilities that they didn't have before, whether it's lending or whether it's more on the product side. It takes a lot to be a custodian. It seems like a relatively straightforward business, just holding assets, but there's a lot of products, solutions, really requirements that everyday investors and RIA clients have. And I think this will just ratchet up Altruist's ability to close some of the capability gaps that they've had since they launched. And they're very transparent about those. What I'm most excited about this, coming from my vantage point in the industry, is why should an advisor care? To me, there's 5 things that advisors should really take notice of with this acquisition. First one's competition. Every time a well-capitalized player shows up, especially in custody, advisors win. Schwab and Fidelity have fought Vanguard in the asset management space for decades, and more recently in financial advice. Now you add in custody against a firm that doesn't need to be profitable the next quarter, and all of a sudden, we very much have an arms race. And some competition is good for pricing, for service, for innovation. And I think this is going to be only positives for clients across the country, having another competitive option and keeping the incumbents really on their toes. Another reason, the breakaway shortlist has changed. Objection I always heard about Altruist was the tech is great, the AI seems cool, but how do I explain the name Altruist to a 68-year-old client who's leaving Merrill or UBS or Morgan Stanley? While someone may still get some objections because Vanguard may not have the same brand cachet as Goldman Sachs or UBS Private Wealth or Merrill Private Wealth, that objection got a lot weaker today. Really, it's tech-forward independence now without a brand trade-off. It's a genuinely different offer in the market than it was before. Third, I think this is one that hasn't been talked about much, but should be watched closely. Potential for referrals. Schwab confirmed last week that it was taking the SAN or the Schwab Advisor Network client referral minimum from 2 million to 5 million. For anyone not aware, referrals from the retail branches of Schwab and Fidelity are one of the major organic growth funnels for many of the top RIAs in this country and have driven valuations to billions and billions of dollars for firms that are in this program. I really do see this as being a potential new massive referral opportunity of Vanguard existing clients and customers to Altruist custodied RIAs at a time when Schwab is trying to keep more of those referrals from themselves, which is a very savvy strategy, but at the same time probably creates a bit of an opening for Altruist and Vanguard to become a really good referral hub for clients, which is a major draw for signing up new RIAs as clients, for breakaway advisors, et cetera. So more details need to come there. We don't even know if they're starting a referral channel, but I have to imagine that's high on the punch list and will be a very compelling offering in the marketplace. Yeah, think about it. Vanguard is 50 million investors and a CEO who said multiple times that they don't have enough advisors or humans to deliver this advice. So perfect. You now have a massive array of RIAs and more coming to the table who offer that advice, and being able to still serve them, still keep the assets in-house, but do it in a way where Vanguard doesn't have to scale up their advisor force. They now have advisors to refer to. Fourth is pricing. I think the Vanguard effect is going to be real here. When Vanguard started, and even to this day, they've been the one who've pushed down the expense ratio on mutual funds and ETFs. It's been a massive benefit to investors across this country. That's been Altruist's playbook all along too, more focused on the advisor. So offering amazing tech and a custody platform for virtually no cost to an advisor. So I would say whatever you're paying for technology, for custody, and really anything else that Altruist and Vanguard might touch, I would expect it to go down potentially and just have more pressures on the incumbent firms to really sharpen their pencil or to get more creative on pricing and innovation. I think that the fifth thing to keep in mind is Schwab has long used its scale and positioning in the market to best competitors, whether it was going to $0 on tickets for equities and ETFs, et cetera, a number of years ago, or a number of other strategies they've taken. Now you have a firm that has similar scale as Schwab, a reputation for playing the long game, and being comfortable making less money in the process. So again, massive benefit to the advisors to have another major player driving down costs and increasing innovation in the space. But this is not all positives. As with anything, there's the good and the bad, and also some open questions. The biggest, I think, downside or potential thing to watch here, and certainly if you're a BDO at a custodian, this is the line you're using. Vanguard has its own advice business, personal advisor, digital advisor, and a CEO who stated that his goal is that an advisor is in every investor's pocket. So now you have the custodian that's holding your client's assets, also running one of the largest advice operations in the country. We've heard this concern in the past about Schwab or Fidelity, where you have RIA custody, and then these firms have massive retail distribution networks. So certainly Vanguard, I think, will be in the same lane. And if you look at like a Pershing or an LPL or Raymond James, it's a little bit different because they don't have their own channels in the same way that Schwab or Fidelity do. So certainly if you're BNY Mellon in particular, which is a straight B2B custodian, this is a clear point of differentiation for Vanguard/Altruist and certainly versus the other custodians. Next one is Vanguard has said that Altruist will remain a standalone business. The brand will stay intact, the management team, et cetera. But in fairness, every acquirer says versions of the same thing. The real test is let's wait 2 years, 3 years, and see how converging roles or similar roles across the firm start to converge into one. And over time, will they morph Altruist brand and human capital into one structure? Right now, we don't know, but I'm always a bit skeptical with acquisitions that you have the honeymoon period, takes time for the deals to close. And then what happens a couple of years down the line, either as there's new executives in charge, there's turnover, or just there's certain synergies that can be had. And the best way to do it is by combining operations and the like. The next risk, I think it might sound a little bit mundane, but it's culture and speed. Vanguard based in Valley Forge, Pennsylvania, Altruist in LA, very different cultures. Altruist as a fintech company has been super fast to market, building, breaking things, innovating. And Vanguard, I think they've been extremely innovative on pricing, on product development, but I've never heard amazing reviews about Vanguard's technology. So does this kind of convergence of cultures create an issue? Does it create more bureaucracy for Altruist trying to build stuff? Is there kind of a cultural mismatch when it comes to speed of market and innovation? And I think the last thing to keep in mind or to watch is the talent drainage at Altruist post-closing. Altruist was a fintech company and custodian offering equity, lots of upside for people that have taken this journey with them. Vanguard notoriously is the opposite. They don't offer equity to anyone, and they offer their employees high base salaries, and you have a culture of longevity within the firm. So after the lockup period is done or the earnout period is done for any altruist equity owners and many of their employees, does that cause some talent drainage where folks want to go on to the next big thing? Kind of think what will happen to all the amazing SpaceX employees a year from now when their IPO lockups are done? Does that kind of lead them to another opportunity? All these are questions I don't know, but trying to play devil's advocate, I think the biggest potential negative is just the Vanguard advice business as a competitor, a conflict to RIA custody. Let me give you a couple of predictions before we wrap here. I think Schwab and Fidelity will respond fast, whether it's on the AI front or because the pressure is really on. I don't know, maybe the $5 million referral minimum that Schwab just announced, maybe that sunsets after a period of time. I have no idea. I'm also excited to see, we'll call it the tech face-off between Altruist and Robinhood. Robinhood acquired Trade PMR, which is on the Wells Fargo First Clearing platform, and is in the process of launching an RIA custodian themselves. So now you have, I think, two pretty incredible tech-forward custodians really trying to gain market share. So it'll be fun to watch. Could there be a threat in the RIA platform space? So RIA platforms meaning RIAs, we call them supportive versions of independence, where advisors can plug into, they get technology, compliance, operations, et cetera, and still own their business. Given the end-to-end tech stack that Altruist boasts, and they've also been in development of their own corporate RIA, does that become that much more of a competitive feature that could possibly become a solution in and of itself that takes a dent out of these RIA platforms playbook? I don't know, but I think it's possible. Does Altruist Hazel AI, does that push even well beyond custody? There's a ton of AI and fintechs popping up around the industry. Hazel has certainly taken a lot of headlines and attention. With Vanguard behind it now, does that push the price lower? Does it help their distribution? Maybe picture this. If you have a Vanguard-owned product sitting in the daily workflow of a competitor's advisors. So let's say you're a Morgan Stanley, you're a Schwab advisor, et cetera. Do you now have a Vanguard-owned product in Hazel as part of your workflow or your fintech stack? Could be interesting. I will call a referral channel for Vanguard or Altruist, we'll say within the next year or two. I think it would be crazy if that didn't happen, and that will be a massive disruptor. And finally, my prediction is more breakaways landing at Altruist. They've started to crack that door, but now with a powerful brand and reputation behind them, the sky's probably the limit. So in closing, a guy, Jason Wenk, started a company in 2018 in Los Angeles because he thought independent advisors deserved better software at a lower price. 8 years later, one of the most respected financial institutions in the world paid $4 billion for it. And the reason is he was right in that bet. There are always innovators showing up from outside the establishment. And every time one succeeds, advisors end up with more options and more leverage and more negotiating power than they had the year before. It's a consistent theme across the industry. So nothing changes tomorrow. Deals take time. Deals have a way of falling apart. But if you're evaluating custodians, thinking about independence for the first time, wondering whether your current partner is going to keep earning your business, today is a good day to reopen that question. And if you're an advisor, I think cheer this on and be excited. And as a industry participant, I am very excited to see how this deal takes hold and how this pushes the rest of the industry to innovate and continue to be better. So that's it for today. Thank you for hearing my ramblings, and I'll see you next time.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.